If you are waiting until age 70 to file for your Social Security benefits because you believe that is the absolute best way to maximize your retirement income, what you are about to hear may be the most expensive tax lesson of your lifetime.
The conventional wisdom repeated by almost every financial planner, every government brochure, and every Main Street media outlet is simple. They tell you to delay. They tell you that every year you wait past your full retirement age adds another 8% to your monthly check. They show you charts of cascading bars proving that your lifetime benefit will be far larger if you just hold out until age 70.
But for a massive portion of middle-class American retirees, this advice is not just incomplete. It is a mathematical trap that can trigger an automatic tax cascade, destroying your net wealth and costing you tens of thousands of dollars in lost income. In the next 25 minutes, we are going to go through the exact mechanics of this filing trap so you can protect your savings before it is too late.
Here is precisely what we will cover in this report. First, we will walk through the 5-step calculation that determines your provisional income, which is the hidden formula the federal government uses to tax your Social Security benefits. Second, we will look at the specific tax bracket thresholds where every dollar of extra Social Security income actually forces more of your traditional retirement accounts to be taxed at rates as high as 85%. Third, we will analyze how delaying your filing to age 70 forces your traditional IRA required minimum distributions to collide with your peak Social Security checks at age 73, creating an irreversible tax spike. Fourth, we will look at the exact federal form SSA 52-1, which allows you to execute a complete filing reversal if you are within your first 12 months of benefits and want to undo a costly mistake. And fifth, we will go through the 4 tax planning strategies, including strategic Roth conversions and qualified charitable distributions, that shield your monthly checks from the Internal Revenue Service automatically.
My name is Arthur. I work as a federal retirement and Social Security specialist. My office focuses exclusively on retiree tax planning, Social Security optimization, and transition wealth protection. We handle roughly 900 retiree filings and wealth strategies every single year. This means we see the exact same financial mistakes repeat across the same demographic categories season after season. The filing trap we are discussing today is the single most common self-inflicted tax wound we see among middle-class retirees who did everything right, saved diligently in their traditional accounts, and delayed their benefits expecting a secure retirement. To understand how this trap springs, we have to look at Joyce.
She lives in a quiet suburban neighborhood outside Charlotte, North Carolina. She worked for 32 years as an administrative director for a regional hospital group, saving diligently in her employer-sponsored 401k plan. She retired at age 65 with $750,000 in her traditional retirement account, which was subsequently rolled over into a traditional IRA. Her plan was simple. She would live off small, calculated withdrawals from her IRA from age 65 until age 70, allowing her Social Security benefits to grow to their absolute maximum limit. Joyce did exactly what she was told to do. She lived modestly, keeping her annual IRA withdrawals at $40,000 a year to cover her basic living expenses. On her 70th birthday, she filed for her Social Security benefits. Because she delayed her filing, her monthly check was $3,600, which is $43,200 a year. This was the peak benefit she had been promised. Joyce was thrilled. She believed her retirement was completely secure and that she could now reduce her IRA withdrawals because her Social Security check covered almost all of her basic needs. But on April 15th of the following year, Joyce sat down with her tax preparer. Joyce expected a modest refund or perhaps a small double-digit tax bill. Instead, her tax preparer informed her that she owed the federal government $4,812. Even worse, her Medicare Part B premium, which had been $174 per month, was being increased to $244 per month for the upcoming year because of a surcharge known as the Income-Related Monthly Adjustment Amount, or IRMAA. Joyce was stunned. Her income had not changed. She was still spending the exact same amount of money each month to live.
But by introducing her peak Social Security check of $43,200 on top of her modest IRA withdrawals, she had crossed a series of invisible federal thresholds. She had triggered the 85% Social Security tax bracket, and she had pushed her adjusted gross income past the first Medicare premium surcharge limit. Over the course of her retirement, assuming she lives to age 85, this single decision to delay her filing to age 70, thereby forcing her retirement distributions and Social Security benefits to peak simultaneously, will cost Joyce an estimated $184,000 in unnecessary income taxes, premium surcharges, and lost compounding growth. The mechanism that created this financial disaster for Joyce is called provisional income. Let's break down how this works. Most retirees believe that Social Security benefits are tax-free. Others believe they are taxed just like ordinary income. Both of these beliefs are wrong.
The federal government uses a unique hybrid formula to determine how much of your Social Security check is subject to federal income tax. Your provisional income is calculated by taking your adjusted gross income, excluding your Social Security benefits, then adding any tax-exempt interest you received from municipal bonds, and finally adding exactly 50% of your total Social Security benefit. The resulting number is your provisional income. If you are a single filer and your provisional income is under $25,000, your Social Security benefits are completely tax-free. If your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits are subject to ordinary income tax. If your provisional income crosses $34,000, up to 85% of your Social Security benefits are taxable. For married couples filing jointly, the thresholds are only slightly higher. If your joint provisional income is between $32,000 and $44,000, up to 50% of your benefits are taxable. If your joint provisional income crosses $44,000, up to 85% of your benefits are subject to income tax.
The trap lies in the fact that these thresholds are not indexed for inflation.
They were set in 1983 for the 50% bracket and in 1993 for the 85% bracket. They have never changed. This means that as wages have risen and as retirement checks have grown larger to keep pace with the cost of living, more and more middle-class retirees are forced into the 85% tax bracket automatically. When Joyce was withdrawing $40,000 a year from her IRA and receiving zero Social Security, her provisional income was $40,000. When she added her peak Social Security check of $43,200, her new provisional income was $40,000 plus $21,600, which is $61,600.
This put her far past the $34,000 threshold, exposing 85% of her entire Social Security benefit to federal income tax. But the trap goes even deeper. At age 73, the federal government requires you to start taking required minimum distributions, or RMDs, from your traditional IRA and 401k accounts. You have no choice. You must withdraw a specific percentage of your accounts every year, and that withdrawal is treated as ordinary income.
If you have delayed your Social Security to age 70 to get the maximum check, your peak Social Security benefit will collide head-on with your mandatory RMDs at age 73. This creates a permanent, artificial tax spike that can push you into a much higher ordinary income tax bracket, increase your Medicare premiums permanently, and wipe out the financial benefit of waiting to age 70 in the first place.
Consider Robert.
Robert is 68 years old and lives in Phoenix, Arizona. He retired from a career in manufacturing with $600,000 in a traditional 401k. He currently receives a modest pension of $24,000 a year. Robert planned to wait until age 70 to file for his Social Security, which would give him $36,000 a year. But Robert also has to contend with his 401k. At age 73, his mandatory RMD will start at approximately $26,000 a year. If Robert waits until age 70 to file, his total income at age 73 will be his $24,000 pension, his $36,000 Social Security check, and his $26,000 mandatory RMD, for a total of $86,000 a year. Because of the provisional income formula, 85% of his Social Security check will be fully taxed, and his ordinary income tax rate will jump from 12% to 22%.
If Robert files for his Social Security now, at age 68, his monthly check will be smaller, approximately $30,000 a year. But by taking the smaller check now, he can use the next 5 years before his RMDs start to execute targeted Roth conversions, systematically moving money out of his traditional 401k and into a tax-free Roth IRA.
This reduces his traditional account balance, which shrinks his future mandatory RMDs and ensures that when he hits age 73, his total taxable income is significantly lower. By taking a smaller Social Security check early, Robert actually saves over $90,000 in lifetime taxes and preserves the longevity of his retirement nest egg. Eleanor is a retired registered nurse living in Columbus, Ohio. She is 71 years old. When she was 65, her husband passed away, leaving her with his traditional IRA of $500,000 and her own traditional IRA of $300,000. Eleanor waited until age 70 to file for her survivor benefits, which gave her $48,000 a year. She also has a small pension of $12,000 a year. This year, Eleanor turned 73, and her combined mandatory RMDs hit $34,000. Her total income is now $94,000 a year. Because she is a single filer, this income pushes her adjusted gross income past the first Medicare premium surcharge threshold of $103,000 when her tax-exempt interest is included. Her Medicare premiums have spiked, and 85% of her survivor benefit is fully taxed. Eleanor did exactly what she thought was the responsible thing to do by delaying her filing, but she is now trapped in a permanent high tax bracket that she cannot escape. Thomas is a self-employed business owner in Austin, Texas. He is 69 years old and has a traditional simplified employee pension IRA worth $900,000. He has no pension and plans to delay his Social Security to age 70 to receive $45,000 a year. Thomas believed his tax rate in retirement would be extremely low because he has no corporate pension. But at age 73, his mandatory RMDs will start at approximately $38,000 a year. When combined with his $45,000 Social Security benefit, his total income will be $83,000. Because he is self-employed, Thomas also pays self-employment tax on his remaining consulting work. By waiting until age 70, Thomas has ensured that his peak Social Security check will be taxed at the maximum possible rate, while also increasing his self-employment tax exposure. If Thomas had filed at age 66, he could have used his lower tax years to withdraw money from his pension plan at a flat 12% tax rate, avoiding the massive ordinary tax brackets that await him at age 73. If you find yourself in a situation where you have already filed for your Social Security benefits, or if you are approaching retirement and want to avoid the tax trap that Joyce, Robert, Eleanor, and Thomas encountered, here is exactly what to do in this exact order, starting today. Item 1. Calculate your projected provisional income for the upcoming tax year. Do this before making any other retirement decisions. Add up your projected pension income, your traditional IRA or 401k withdrawals, and your tax-exempt interest, then add exactly 50% of your projected annual Social Security benefits. If the total is close to $34,000 for a single filer or $44,000 for a married couple, you are entering the 85% tax bracket. You must adjust your income sources immediately to keep your provisional income below these critical thresholds. Item 2. Execute targeted Roth conversions during your lower income years. The best window for Roth conversions is the gap between your retirement date and the date your required minimum distributions start at age 73. By systematically withdrawing money from your traditional IRA, paying the ordinary income tax at your current low rate, and moving the funds into a tax-free Roth IRA, you achieve two things. First, you reduce the total balance of your traditional accounts, which permanently shrinks your future mandatory RMDs. Second, you build a pool of tax-free assets that you can withdraw from in retirement without increasing your provisional income or your Medicare premiums. Item 3. Utilize qualified charitable distributions, or QCDS. Once you reach age 70 and a half, a QCD allows you to transfer up to $100,000 per year directly from your traditional IRA to a qualified charity. The beauty of this strategy is that the transferred amount counts toward your mandatory required minimum distribution for the year, but it is completely excluded from your adjusted gross income. This means the money never enters the provisional income formula, keeping your Social Security benefits tax-free while satisfying your legal withdrawal requirements. Item 4. Use the Social Security filing withdrawal process if you are within your first 12 months of benefits and realize you made a mistake. If you filed for your benefits early, or if you delayed your benefits and realized you triggered a major tax trap, you can file Form SSA 521, which is a request for withdrawal of application. This form allows you to completely undo your filing, stop your monthly payments, and let your benefit continue to grow. There is one critical caveat. You must repay every dollar of Social Security benefits you and your family receive during that 12-month window. If you have the liquid cash to repay the benefits, this is a powerful reset button that allows you to redesign your retirement tax strategy from scratch. Item 5. Shift your taxable investments into tax-efficient structures that do not generate ordinary income or capital gains that enter the adjusted gross income calculation. This includes utilizing individual stocks with low dividend yields, tax-managed mutual funds, or specific cash value life insurance policies that allow for tax-free loans. Be extremely careful with municipal bonds. While municipal bond interest is exempt from ordinary federal income tax, it is explicitly included in the provisional income formula for Social Security taxation. Many retirees buy municipal bonds believing they are completely tax-free, only to discover that the interest pushes their Social Security benefits into the 85% taxable bracket. There is one advanced planning strategy that almost no retiree is told about, and even many certified public accountants frequently overlook. If you experience a sudden reduction in your retirement income due to retirement, a reduction in hours, the loss of a pension, or the death of a spouse, and your Medicare premiums spike because of the IRMAA surcharge, you can appeal the surcharge immediately using Form SSA 44. This form is called a Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Appeal. The federal government calculates your Medicare premiums based on your tax return from 2 years prior. If your income was high 2 years ago because you were still working, but has dropped significantly this year because you retired, the SSA will still charge you the higher premium unless you file this exact form. By filing Form SSA 44 and providing proof of your retirement or income reduction, you can force the agency to recalculate your premiums based on your current year income, saving you up to several $1,000s a year in unnecessary premium surcharges. To help you navigate these complex rules, my office has put together a comprehensive step-by-step guide called the Retiree Protection Checklist. It is a detailed guide that you can download completely for free at arthurgravestax.com/checklist. This checklist contains 47 pages of detailed step-by-step instructions. It includes direct links to every federal form we discussed today, including Form SSA 52-1 and Form SSA 44. It contains the exact worksheets our office uses to calculate provisional income thresholds for single and joint filers. It walks you through the precise phone tree path to reach a live human Social Security representative in under 12 minutes, bypassing the average 41-minute hold time. And it includes a one-page printable summary of the key tax dates and thresholds that you can keep on your desk or share with the person who helps manage your family finances. The guide is completely free, there is no obligation, and you can access it immediately at arthurgravestax.com/checklist. For those of you who realize you need to file an amended return for a prior tax year because you discover your Social Security benefits were taxed in error, the software our office utilizes for amended retiree returns is a trusted federal-level tax preparation platform. They have established a special discount link for retirees in our audience that provides 25% off their premium amending tier. I am an affiliate for this platform, which means my office earns a small commission if you utilize our link, which helps support the production of these educational reports. The link is located in the description box below this video. The single most important decision you will make regarding your retirement security is not how much money you can save, but how efficiently you can protect that money from unnecessary taxation once you stop working. Waiting until age 70 to file for your Social Security is a powerful strategy, but only if you have systematically prepared your traditional retirement accounts to prevent the massive tax collision that awaits you. Take the time this week to calculate your provisional income, check your My Social Security account profile, and review your retirement account balances. If this report provided you with clear, actionable value, please hit the like button and subscribe to the channel. Every single subscription tells the YouTube algorithm to share this report with another retiree who needs to protect their hard-earned savings from these invisible tax traps. If you have a friend, a coworker, or a family member who is approaching age 70 and planning their retirement, please share this video with them today. The next report on this channel will cover the 3 major Medicare Part D changes taking effect next month, including a critical adjustment that will impact anyone utilizing brand name maintenance prescriptions. I will see you in the next video.